Hi everybody, welcome back to our discussion of Chapter 11. In this video, we'll discuss issuing preferred stock and payment of dividends to preferred shareholders and common shareholders. As always, I strongly recommend that you download and print the PDF version of this worksheet or download the Excel workbook so you can follow along and practice with the video. Preferred stock is discussed in your textbook starting on page 426. Preferred stock receives a preference with respect to dividends before any common shareholders get their dividends. Preferred stock also has a preference for distribution of assets if the corporation is liquidated. Preferred stock usually does not carry voting rights, and it usually has a par value and can be sold for a price different from the par value. Example, Johnson Boating sells 750 shares of 6% $100 par value preferred stock for $100,000 cash. Calculate the amount to be credited to the preferred stock account. 750 shares times $100 par value equals $75,000. Write the journal entry required to record the issuance of this stock. Debit cash for the $100,000 cash received. Credit preferred stock for $100 par value for $75,000. And credit paid in capital in excess of par value preferred stock for $25,000. Dividend preference on preferred stock is discussed on page 427 of your textbook. Preferred stockholders have a right to receive their dividend before any dividends are paid to common shareholders. Preferred stock is not a guaranteed dividend. Corporations are not required to pay dividends. Therefore, having preferred stock simply does not guarantee a dividend. However, if dividends are declared, the preferred stockholders have a right to receive their dividends before any dividend is paid to common shareholders. Dividends allocable to preferred shareholders are usually expressed as a dollar amount per share or a percentage applied to par value. Example, Johnson Boating has 750 shares of 6% $100 par value preferred stock issued and outstanding. Calculate the amount of dividends the preferred shareholders would be entitled to receive if the company declares and pays a dividend. This dividend is calculated as a percent applied to par. It specifies that it's a 6% $100 par value stock. And the way the dividend is calculated is by taking the par value of $100 times the specified percentage, 6%, equals $6 dividend per share times the total shares of preferred stock issued and outstanding, and that would mean that the preferred shareholders are entitled to receive $4,500 if the corporation declares and pays a dividend. Page 427 of your textbook also talks about cumulative versus non-cumulative preferred stock. And this starts to get fun. Non-cumulative preferred stock is not entitled to receive dividends for any year in which dividends are not paid or in which dividends are not paid in an amount sufficient to satisfy the obligation to the preferred shareholders. Cumulative preferred stock is entitled to receive dividends for years in which dividends are not paid. The unpaid dividends accumulate, and if a dividend is paid, all dividends in arrears must be paid first to preferred shareholders, then the current year dividend must be paid to preferred shareholders, and only then can common shareholders be paid. Example: assume a corporation's outstanding stock includes 1,500 shares of 8% $100 par value preferred stock and 5,000 shares of $75 par value common stock. In 20X1, its first year of operations, no dividends are paid. In 20X2, the Board of Directors declared and paid cash dividends of $10,000. In 20X3, they declared and paid a dividend of $40,000. First, let's calculate the amount of annual dividends the preferred stockholders would be entitled to receive if dividends are paid. $100 par value times 8% equals $8 per share times 1,500 shares equals $12,000. Next, calculate the amount of dividend to be paid to the preferred and common stockholders, assuming first that the preferred stock is non-cumulative, then assuming that the preferred stock is cumulative. The first thing to remember about non-cumulative stock is if a dividend is not paid or it's not sufficient to satisfy the $12,000 obligation, it's lost. It does not accumulate. It is non-cumulative. So there are never dividends in arrears, meaning unpaid dividends, on preferred stock that is non-cumulative. So the answer in this column for the non-cumulative preferred stock is 0 all the way down. Now, in 20X1, there were no dividends paid at all. 0 dividends paid. So how much of those 0 dividends went to preferred shareholders? Well, 0. Nothing was paid. They didn't get anything. And how much went to common shareholders? Nothing. Though nothing was paid, they didn't get anything. Now remember that the company is obligated to pay the first $12,000 of dividends that are actually paid in any one year, first to the preferred shareholders, and if anything is left over, the remainder would be paid to the common shareholders. Well, in 20X2, $10,000 of dividends are declared and paid. So an amount was paid. It was not sufficient to satisfy our $12,000 obligation, but it's something at least. So the preferred shareholders get all of the $10,000 that was paid. And if $10,000 was paid and preferred shareholders get it all, how much goes to common? 0. Now in the next year, year 3, $40,000 of dividends are declared and paid. And remember that we have the obligation to give the first $12,000 of annual dividends to preferred shareholders, and if anything is left over, common shareholders get it. So for 20X3, on the non-cumulative example, $12,000 goes to preferred, and the rest, $40,000 minus $12,000 that goes to preferred, equals $28,000 of dividends that can go to the common shareholders. Now let's look to see how much over the 3-year period was paid to the preferred shareholders and how much was paid to common shareholders. The preferred shareholders got $22,000 over the 3-year period, and the common shareholders got $28,000 in a non-cumulative preferred stock example. Now let's do an example where the preferred stock is cumulative. The first thing to remember is that the preferred shareholders are entitled to receive an annual dividend. If dividends are actually paid, they're entitled to receive an annual dividend of $12,000. And in a cumulative preferred stock situation, they don't lose it. It is the amount of unpaid dividends, referred to as dividends in arrears, is kept track of. It's not a real liability because the corporation has no obligation to actually pay dividends. They could go for the entire life of the corporation and never pay a dividend, and therefore the preferred or common shareholders would never get anything. But in a preferred stock that is a cumulative preferred stock situation, if years go by and the $12,000 is never paid, then when finally some dividends are paid, we have to start paying off the old obligation to the preferred shareholders. So there are dividends in arrears in these years. In the first year, we owe the preferred shareholders $12,000. But there were no dividends paid in 20X1. So the preferred shareholders got nothing, and the common shareholders got nothing. But we have dividends arrears. We owe them $12,000 for X1. In X2, we actually paid $10,000 of dividends. Let's take a look at how much we owe the preferred shareholders and who we're going to give that $10,000 to. We owe our preferred shareholders $12,000 that was not paid from X1, plus $12,000 annual payment due for X2. So we actually owe them $24,000. But only $10,000 of dividends were paid. So we give all of it to the preferred shareholders and nothing to common. Now let's figure out how much dividends are unpaid at the end of year 2. $12,000 unpaid from year 1 plus $12,000 due for year 2 minus $10,000 actually paid to them in year 2 leaves $14,000 in dividends and arrears at the end of year 2. Now in year 3, $40,000 worth of dividends were paid. Let's figure out how much is due to our preferred shareholders, cumulative preferred shareholders. The $14,000 left unpaid at the end of year 2, plus $12,000 due to them for year 3, equals $26,000 due to our preferred shareholders. And we actually paid $40,000. So we have paid enough to totally satisfy our preferred share obligation to our preferred shareholders. So we're going to give them $26,000. And when we do, we've totally paid them off. We paid them the $14,000 still due at the end of year 2 plus the $12,000 due for year 3. So our dividends in arrears to our preferred shareholders is 0 at the end of year 3. Now the question is, how much do we need to pay to our common shareholders? Well, remember that preferred shareholders have a dividend preference. They get paid their full dividend first, and anything left over gets paid to common. Well, there was $40,000 of dividends paid, minus the $26,000 we allocated to our preferred shareholders, means that the $14,000 left over goes to the common shareholders. Now let's see in this example how much was paid to common and preferred. So over the 3-year period, $36,000 was paid to the preferred shareholders and $14,000 was paid to the common shareholders. So let me ask you a question. If you had the option of buying cumulative preferred or non-cumulative preferred, and the corporation does actually pay dividends, which one would you rather have? Well, I think I'd rather have the cumulative preferred because it's pretty obvious they end up getting more dividends if it's cumulative preferred. In this chapter, I also want you to make sure that you study definitions for participating and non-participating preferred stock, shown in the book on page 427. Well, that's all for this video. See you next time.